Success in trading doesn't come from a magic indicator or a secret system. It comes from emotional discipline and solid risk management. One emotional mistake can destroy weeks of progress: chasing a missed entry, doubling on a losing trade, or revenge trading after a loss. Traders often believe they just need one more adjustment, one more indicator, one more confirmation. But the truth is, the problem isn't the chart. The problem is the trader. Today we're going to talk about the missing piece of the puzzle, the one thing that separates successful traders from the 90% who struggle. That missing piece is trading psychology. Think of it this way: if your technical skills are the engine, then trading psychology is the fuel. Without it, you won't get anywhere, no matter how powerful the engine is. In today's video, we'll discuss what trading psychology really means, how it affects your performance in the markets, and 7 key rules that will help you master your mindset and trade with discipline. So guys, if that's something that you're interested in, make sure to hit the like button to support our work and subscribe to our channel if you're new. Trading psychology. Trading psychology means how you make decisions under pressure. It focuses on the mental and emotional aspects of trading and how your mindset, emotions, and discipline influence your actions and overall performance. It is important because even with the best trading strategy, you can still fail if you cannot control your emotions. Consider this common situation. A perfect trading setup suddenly appears on the chart. All the signals suggest that the price will go up. You have not seen such a perfect signal alignment in weeks, so you decide to go big on this one. You think, if I risk half of my capital and aim for a 1-to-2 risk-to-reward ratio, I can double my account in one trade. This is just what I need after all my hard work. You set up the trade and then, suddenly, half of your account is gone. The market moves against you and reminds you of a very important lesson. No matter how perfect a trading setup looks, you must always follow your risk management plan. There are many emotional mistakes like this. The fear of missing out makes you enter the market too early, only to watch the price move as you predicted, but after it has stopped you out. Closing a trade too early, only to see the price reach your target afterward. Doubling on a losing trade or revenge trading. Now, enough of the chatter. It is time to learn the skills of trading psychology to improve your trading success and avoid emotional mistakes. On this subject, we have gathered 7 trading psychology rules to help you achieve greater emotional control, improve your decision-making under pressure, and increase your overall trading success. Rule number 1. Have a rules-based trading plan. A rules-based trading plan helps you make decisions objectively instead of emotionally. It defines exactly the conditions you are going to enter a trade, where your stop and target should be, and how to manage your positions. Here's an example of a rules-based trading setup. Identify a double top pattern and let the price clearly break above this level. Draw a line from the highest close and wait for the price to pull back and touch the line. After that, the only thing we need to enter a long trade is a candlestick closing above the previous one. This is our signal to open the trade. Set your stop loss below the lowest point of the swing low and target 2 times your risk. Now imagine that in the same trading setup, we decided to enter the market when it shows signs of a reversal, such as a long wick candlestick. But here's the question. Is this considered a long wick rejection candle to you? Maybe half of you would say yes, and the other half no. And that's exactly what makes the setup subjective. So the second rule is this: make your trading rules non-subjective. To do that, we can define our long wick rejection more precisely. For example, a candlestick qualifies as a long wick rejection if the lower wick is equal to or greater than twice the size of the body. Now let's test that rule. We have a candle with a lower wick of 9 pips and a body of 4 pips. Does it qualify as a long wick rejection? I'm sure all of you said yes, unless you hated your math teacher back in school, because 9 is more than twice 4. And that's how you make your trading rules non-subjective, leaving no room for emotions or uncertainty in your decisions. It also ensures that your backtesting results are more closely aligned with real market conditions. The closer your backtesting is to reality, the more confidence you gain in your system. Realistic backtesting provides you with reliable data, enabling you to evaluate your strategy objectively and make informed adjustments over time. Rule number 3. Stick to your risk management plan. Now, what is risk management? Risk management means protecting your money while you trade. It's about deciding how much you're willing to lose on a trade before you even start, so one bad trade doesn't wipe out your account. In other words, risk management is like wearing a seatbelt while driving. It won't stop accidents, but it keeps you safe when something goes wrong. Here are some of the risk management actions as an example. You only risk a small part of your money, like 1 to 3%, on each trade. You set a stop loss, which automatically closes your trade if it starts losing too much. You don't put all your money in one trade or one market. Now here comes a key question. How much should you risk per trade? The answer depends on your risk tolerance, which is the amount of money you are comfortable losing when you encounter inevitable losing trades. There are 2 types of risk tolerance to consider: risk per trade and overall capital risk. Ask yourself, what percentage of your capital are you willing to risk on each trade and still feel comfortable if things don't go your way? Also, if you experience several losing trades in a row, such as 5 consecutive losses, how much of your total account loss can you handle without letting emotions affect your future trading decisions? Your answers will help you build a solid money management plan, and following that plan will help keep emotions out of trading. If you risk more than you are truly comfortable losing on a trade, your emotions will start to control your decisions. For example, if you risk 5% of your account per trade and lose 5 times in a row, your account will be down 25%. That is a significant loss and could influence your confidence. So you might want to reconsider your risk management plan. But wait, why not risk a very small percentage of your capital, like 1% or even lower? The reason is that the amount you risk also determines your potential profit. For instance, if you have a small account and risk only 1% per trade with a 1-to-1 risk-to-reward ratio, you will gain just 1% on a winning trade, which might not feel rewarding after all the effort you put into trading. The goal is to find a balance where your wins feel motivating but your losses remain manageable. If I were a beginner with a small account, I would probably risk around 2 to 3% of my capital per trade. This way, even with 10 consecutive losses, I would only lose about 20 to 30% of my initial capital. Remember, risk management doesn't stop here. It's the foundation that keeps you alive in the market. Rule number 4. Do not overtrade. Overtrading happens when you take too many trades, often because you're chasing losses or trying to force profits. Remember, quality is always better than quantity. Stick to your trading plan, wait for high-probability setups, and don't let boredom or frustration make decisions for you. Maybe you've had a few winning trades in a row and start to feel unstoppable. You begin trading every tiny price movement because you don't want to miss out. That's greed, and it often ends with giving back your profits. Sometimes you're just bored. The market is slow, so you trade just to feel active. That's still overtrading, and it usually ends badly because boredom trades rarely follow your strategy. Remember, more trades don't mean more profit. Each trade carries risk, and the more you trade, the more chances you have to make mistakes or lose focus. Rule number 5. Keep it simple. Many traders believe that using complex indicators, advanced tools, or multiple strategies will make them more successful. In reality, simplicity is the key to success in trading. A clear and easy-to-follow plan helps you make faster, more confident decisions. When your chart is filled with too many indicators, signals, and lines, it becomes confusing. You start second-guessing your trades, missing opportunities, or breaking your own rules. After all, the price can only go 2 ways, up or down. Even with your eyes closed, you'd still have a 50% chance of being right. Keeping your strategy simple doesn't mean it's weak. It means it's focused. Simplicity helps you to know what you are doing and why you entered or exited a trade. Remember, your goal is to trade well, not to impress anyone with a complicated chart. So remove all the unnecessary and absurd information and focus on the naked price action itself. Rule number 6. Do not revenge trade. One mistake often leads to another in trading. For example, Imagine you just took a big loss because you didn't follow your plan or ignored your stop loss. You feel frustrated and want to earn that money back right away. So you jump into another trade without thinking it through. That's called revenge trading, and it usually makes the situation worse. Revenge trading happens when emotions take control after a loss. Instead of calmly analyzing what went wrong, you try to force a quick win to fix your mistake. But in doing so, you break your rules again. This cycle can destroy your confidence and your account. So whenever you make a mistake or break your trading or risk management plan, do not try to win it back immediately. Take a break. Step away from the screen. Give yourself time to calm down and clear your head. Once you're ready, journal your mistake. Write down what happened, why it happened, and what you'll do differently next time. That's how you turn a loss into a lesson. Rule number 7. Manage your trade to reduce pressure. In this part of the video, we're going to explain trade management strategies that help you reduce mental pressure, secure some of your profits, and catch massive risk-to-reward trades. It's all about what happens after you take the trade. So imagine you've entered a trade in this situation to take advantage of the bull market, placing your stop loss below the engulfing candlestick. A common trading approach is to aim for a solid risk-to-reward ratio, like 1:2 or 1:3. The problem with this method is that as the price approaches your target, you start to feel anxious that it might reverse, turning a winning trade into a losing one. And sometimes, that's exactly what happens. Or you might close your trade too early, only to see the price eventually hit your original target without you, leaving potential profits on the table. So here are some practical solutions for trade management. Ways to lock in profits while still giving your trade room to run. Number 1 is making your trade break even. So how do you make your trade break even? When the price reaches your 1-to-1 target, close half of your position in profit. This way, even if the price reverses and hits your stop loss, you will lose no money because you have already closed the same amount in profit. But if the price continues to rise and hits your upper targets, you will gain massive wins with minimal emotional pressure. The second strategy is trailing profits. Trailing profits mean repositioning your stop loss to a new market structure level when the price moves in your favor. For example, imagine the previous situation one more time. We have entered a long trade and are expecting the price to push higher. If the price breaks above the structure and forms a new swing low, we can reposition our stop loss from the original point to just below the new swing low. When we do this, we secure some profits and prevent the trade from turning into a loss. We continue this process until the price reaches our higher time frame target or reverses downward. For example, if the price breaks above a new high, we reposition the stop loss below the latest swing low. The same process continues and eventually the price drops and closes our position with a massive win. So guys, that's it for this video. I hope it was helpful for you. If it was, don't forget to give it a like and subscribe to our channel if you're new. And don't forget to share your thoughts in the comments. See you in the next one.